Good morning or good afternoon, depending on when you are listening to this podcast. This is the Domicile Real Estate Podcast. My name is Stephen Mead. I'm the broker here at Domicile. We are real estate for people who love housing. And this week, we are bringing a guest that really, I think this is long overdue to have this conversation. And I'm going to introduce him in a second. He is a mortgage lender, but I want to kind of set this up a little bit. And that is, I have a theory about buyers and people when they're refinancing. I think a lot of people are very afraid to talk to a mortgage lender. And I think a lot of that fear comes down to, they feel like their entire financial life is going to be judged. They might face some kind of rejection, like no home for you. And, that's not really the way it works. And I think it's important that people go in and they're not afraid of talking to a mortgage lender, because there's a lot of valuable information there. A lot of things, even if you're not ready to buy a home now, it's important for planning. And I think you shouldn't be afraid to reach out and take that first step. So without further ado, I'm going to introduce the mortgage lender we have on our podcast today. His name is Paul Cawthorne. I have known him for over 10 years. He has been a mortgage lender for, he can jump in and say how many years he has been a mortgage lender. But he has done numerous transactions for me, and he is of the approach of really providing a lot of information and options to clients and explaining things. And I think that is really, bar none, the single most important thing in a mortgage lender. This is the biggest amount of debt that you will ever take on in your life, most likely. And it's really important to understand, your options and also how all this works. So want to welcome Paul to the podcast. Do you have anything else to say in your introduction, Paul?
Well, just that 17 years, started working in mortgages in 2003 in the run up to the bubble. And yeah, I mean, what the idea that borrowers are hesitant or nervous about speaking to lenders, I think is real. And I think there's a delta, as somebody just said to me in another conversation, between what borrowers need and what they get when they visit their bank or credit union, or just in general, the type of service they receive.
What do you think they're missing? I know this because I'm in the industry, right? But I think a lot of people who are watching this might not understand exactly what that means. Like, what do you think people don't get? Like, what's the number one thing that you think people are missing, especially when you talk to them after maybe they've talked to somebody at a bank? Because I know a lot of times clients come to you and you're the second lender.
You were just saying. It's exactly what you were just saying. It's options. Essentially, if there's one word, I would say they're missing a consultation from a mortgage professional who knows what their options are going to be with respect to down payment options, mortgage, what loan program options are available. Giving a high level view of what the entire process looks like from the very beginning. I'm considering buying a home to I have my keys in my hand and I'm walking through the front door. Just a high level consultation that kind of touches on all aspects of that process is something. I mean, the reason I know that is the case, that this is missing, is that without, I wouldn't say everybody, but I'd say 95% of the borrowers that I speak to when we are done with our initial consultation are blown away that, oh my God, this was so helpful. This has been so helpful. Helpful is the word that comes out. And it's just, as it's just imparting what I know to them as briefly as possible. So, that they feel they're making empowered decisions.
I think a lot of people sort of view it like going to the dentist. It's like when their tooth hurts, they know they need to go to the dentist because it's that's an important part of the process for not having a disastrous outcome. But I think they're just very afraid of what they're going to find when they get there. What happens when somebody calls you initially? Like what is that conversation? What does that look like? And I'm sorry for harping on this, but I think this is a huge deal. I think, when I talk to new buyers, right, I'm like, oh, have you been pre-approved? Boy, they hit the brakes so fast. That's the part of the process they are so afraid of. Like, looking at houses is fun, right? talking to a mortgage lender, that feels like going to the dentist for them. So what happens when people call you initially?
Well, I think this ties into, what are the major preconceptions that buyers or borrowers have, right? Um, a lot of times, the first thing that comes up is we're going to need 20% down payment, right? Um, and the answer is no, you do not. Um, and then people are fixated on affordability, which is good. A lot of times the borrowers that I speak to these days think there's been a kind of shift, from the run up to the bubble, and then from the bubble to now. People are a lot more conservative nowadays, and they'll be concerned that um, they will incur too much debt. So, I mean, that's a big question that I get. How do I know that I'm going to be able to afford this monthly? I have this number in my mind that I want to pay every month. And so that's something that we get into a lot as well.
How do you think, it's funny, you bring up sort of the bubble, and for anybody who's listening, who's maybe a little bit younger and didn't go through this as someone in the real estate space, we're kind of referring to that sort of like 2007 to 2012 period that was really rough in the real estate space. A lot of people did lose their homes. There was a lot of an anguish. Do you think that 2020 looks and feels like that? I know you mentioned already that buyers are kind of coming in with maybe a different attitude about affordability than they did. But, what do you think about some of the people who say, oh, it feels like this is happening all over again? I mean, obviously I have my viewpoint and I'll share that after yours, but I'm kind of curious what you think.
Well, I mean, you and I discuss the market, and that's one of the things I like about you is that you're so thoughtful. So a lot of what I think. I mean, I'd say there is a lot of appetite for risk on the lending side now, and you've seen that after the
Put it
bubble.
in English. Are you saying like when you say appetite for risk, you mean like lenders are easier, right? Like they're more willing to give out money to people. I know right after the financial crash, lenders were like, little old ladies in the depression, like clutching their purse with three pennies. And
Well,
now
that's
now
precisely
it's
what I'm talking
changed, right?
about.
Like, yeah.
In the wake of the credit bust of 2008, essentially, you couldn't, all kinds of different mortgage financing disappeared. And you've seen, and we've discussed this, that slowly but surely it has all returned to market, but with some very important caveats. Everybody knows the stated income loan. There's the story goes around in the mortgage industry, and I think maybe even in the real estate industry, the realtors, of the kid working at Blockbuster who bought a $500,000 house in the run up, right? And he did it with a stated income loan, and he was making, 25 grand a year. And there was absolutely no way he would qualify, but you could just simply state your income. And you could state your income and do zero down payment.
I know. Wow.
And then I think right in the months before the crash, the craziest loan program I saw was a no income, no asset, 540 credit score, right? I mean,
that is what we refer to as the fog of mirror loan, right? Like that is the only requirement, is that you show that you are breathing and alive, and you can get that loan,
yeah,
right?
yeah. You need a pen to sign the document. It was madness. So but while some of these types of mortgages are returning to the market, it's much different. The down payment requirements are typically 30% on these more exotic loans that have returned to market, and it's not like a stated income loan so much as it's the lender does not require evidence of income, and they have higher credit requirements. So, I mean, so while I say that there's an appetite for risk amongst lenders, what I mean is mortgage lenders are allowing riskier loan programs now, and you know, that's a result of the demand for housing, you know, and providing solutions to that demand.
I mean, I think the biggest thing for me is that I don't see speculative buyers. Like I remember in 2006, there was the kid at Blockbuster who was taking on a loan that he had no ability to repay. But hey, it was going to be fine because he was going to turn around and sell the house in 6 months for $100,000 more, so it wouldn't matter. And I don't see those kind of buyers in the marketplace. Like most of my buyers right now are high credit. They're either people that are moving up, like they made some money on a house they bought maybe 4 or 5 years ago, or they are first-time home buyers that maybe waited a little bit longer, right? And you know, they have good jobs, they have solid incomes, and they have excellent credit. Like I'm not running into a lot of buyers that have low credit that are just trying to like make it work because they see sort of like the gold in their eyes of speculative buying, you know, oh, I'll make $100,000 next year on the house. I think, you know, most of the buyers we work with are kind of like, well, you know, we're buying a house for our family or our living situation, or whatever, to use. And, you know, hey, we know this is a long-term investment. If it goes up next year, great. If it doesn't, we have a place to live, you know, that we love. And I feel like that's a much better attitude to have going into home buying
Yeah,
versus the
well,
other.
yes. I mean, you know, if the conversation is what's different now, you know, are we in a bubble now? Are prices rising to the point that we can compare this to 2006, 2007 on the run up? Not in any way can you really compare it. The borrowers are much less speculative, as you've said. People are taking advantage of low rates, and to get into a purchase.
You
So
know, I always tell people, and I think this is a fact that is missed by people because I think we're in a very short attention span world. I tell people not only are rates low, but you are getting a 30-year fixed rate mortgage. This means for the next 3 decades, you will be enjoying that. That kind of financial certainty, it does not really exist in any other part of the financial world. And in fact, the 30-year fixed rate mortgage is kind of an American anomaly. Like it's not something that exists in other parts of the world. So I mean, I always tell people like, just remember, like there might be a time when interest rates are 10, 11%, and you will still be enjoying that 2 point whatever percent mortgage or 3% or whatever the number is, you know, mortgage that is extremely low. You will get to enjoy that 20 years from now if you so choose. And, you know, I think that kind of long-term thinking is something that I wish more buyers had a little bit because I think they don't realize what a sort of amazing opportunity that is to lock in a rate that is when you factor in inflation, it's almost free. It's almost like 0% factoring in inflation. You know, you get to
well,
lock
it's
that in
definitely
for 30
inflation
years.
control.
What, you know,
It's a fixed cost. It's like,
yeah, I mean, you know, rent can go up, all these things can change, but boy, a 30-year fixed rate mortgage, boy, that big part of your payment, that's done. That is decided. I want to shift gears a little bit and talk about something that's a little bit less comfortable, but I think it's really important to talk about, and that is fair housing and housing discrimination. I think, you know, this year we've really seen a lot of things come to light, and I think it's really been eye-opening for a lot of people in the real estate industry, myself included. And you know, there was a report that came out about a year ago in Long Island that kind of showed, I mean, really widespread housing discrimination by realtors on Long Island. And, you know, as a realtor, this is something I'm not very proud of, but I think it's important to acknowledge it because I look at my business and say, how can I make sure that that's not what's happening here in my business and here in Southern California? You know, has there been kind of a similar movement on the lending side of things? I know there was an article about appraisals being, you know, something that is they're highly subjective, right? Like when you submit a loan file to underwriting, Paul, it's the credit score and it's a computerized system. It doesn't know what race somebody is. It doesn't know any of this. It comes and it spits out an approval. But the appraisal process, that is that's equal parts art and science. There's a lot of art in appraisals. I mean, what have you kind of seen in the lending side of the industry about fair housing? Is that something that everybody's talking
Well,
about like they are in real estate?
so two things, to break that up. And on the mortgage side, there is a push to have originators, that's myself, the person at the point of sale, paying close attention to borrower race and ethnicity. And I can only speak for myself, really. I can't really speak for industry wide, but I can tell you that the mortgage company is concerned with tracking this information, being serious about tracking the information, so that we know that we are doing our fair share, and to ensure essentially that all groups get the same rates. That's essentially what you're talking about on the mortgage side. On the appraisal side, personally, I've never had an instance where an African American borrower, a Hispanic or Latino borrower, was getting a lower appraisal. As far as I was aware, at least, we all have to deal with low appraisals in the industry, and when that happens, and if it should ever happen due to race or ethnicity, my first inclination would be to reach out to my internal appraisal team, right, and to review the accuracy and legitimacy of the appraisal report itself.
What
And if
happens? Like, I mean, what happens? Like, let's pretend that we have customers who are buying a house and it doesn't appraise, and not by a little, but it misses the mark by a good margin, and we think it's unfair, and maybe we even think there's the possibility that something came into play. Like, what does that process look like for the
well,
person who's taking out the loan? Like, what recourse do they have?
okay, so I mean, first of all, I will say I'm not an appraiser. Okay, and I don't like to pretend that I am, but of course I have a lot of experience reading appraisals, and with that experience, I would interface with the real estate agent, who's such as yourself, and we'll look at the appraisal and we'll see, are there errors or omissions that we can then take to the lender's appraisal team and say, look, we have these errors that, he's missed this, the adjustments are off, he's used the wrong comparable sales. Can we have a second appraisal performed? And I think this, and I don't know how much you want me to get into the nitty gritty of what
Well, I
the
mean, I think it's
steps would be
okay for people to just understand,
investigation.
like, if it's bogus, there is the possibility to get a second, basically a second
Absolutely,
opinion,
and
right?
like,
They can.
well, to be explicit, if we've got a bogus appraisal, we're going to explain to my internal appraisal team why it's bogus. They're going to take our commentary and go back to the AMC, the appraisal management company handling the appraisal communication. Because as an aside, mortgage lenders cannot speak to appraisers, so we hire appraisal management companies.
Neither can realtors either. For everybody out there listening, we're allowed to have very limited contact. I can give them like a sheet of comps and upgrades on the house and say, if you have any
Yeah,
questions, call me. That's my ability to communicate with them.
appraiser independence is a key factor in today's market, right? Today's mortgage market. Appraisers must be independent to make their own decisions and not be influenced. So back to the situation of a bad appraisal, we would create commentary and go back to my appraisal department and say, look, this appraisal has flaws. The appraisal team would then go back to the appraiser and have him provide commentary based on our commentary. And if he doesn't remediate, if he doesn't fix any issues that have been brought up, then there's a good chance we would have a second appraisal ordered. Okay.
Okay.
But having a second appraisal ordered cannot be simply so that we can chase a value. And I know that's a different question. That's a different circumstance than what we're talking about. But the lender cannot be coercing or forcing a value here. Okay.
No, got it. One of the things too that I wanted to kind of end with, I know we're kind of getting close to the end of our time, is what's kind of your outlook for interest rates in the next year? So I've got two-part question. One is your outlook for the interest rates, and second is, what is the one piece of advice you would give to borrowers who are listening to this, to buyers or people looking to refinance? What's one piece of advice? So,
well, the number one thing I would say to buyers, well, two things I would say. One is you don't need 20% down.
okay, important.
With 5% down payment, you can buy, and excuse me, because we've got new loan limits, but the new loan
It's
limit
over
is
800 in LA and Orange County, right?
Right. 5% down payment gets you into an $865,000 property. Okay, so 865
in Los Angeles and Orange County is correct.
Correct. That's so 43,000 down payment gets you into an $865,000 property. That is the number one thing that I would tell people. You don't need 20%. You can get into 800,000 plus with about $40,000 down payment, which I think would really loosen up a lot of people. The number two thing is that don't be afraid to get pre-approved. You need to know what to expect, what the numbers look like. If anything's going to come up with your credit report or your income, you need to be aware of it so that you can start working on it and position yourself, even if you don't end up purchasing now. Okay.
And if anyone out there is interested too, we're going to put up Paul's contact information, not only in the comments and the description, but also we're probably going to do a slide at the end of this too, if you're watching. So we will have that information available as well.
Okay, great. Now, as far as rates,
what's going to happen? Everybody wants to know what's going to happen in 2021. I want to know.
Well, I mean, there are competing factors here, and it's like fighting for the soul of mortgage interest rate. Obviously, the COVID. COVID is what led us to having mortgage rates below 3%. The shutdown of the economy and its resulting negative effect. And so essentially, there's a way to look at this. Things that are bad news for the economy are great news for mortgage rates. Okay, so when you hear that COVID is surging out there and that more shutdowns are happening, this is great news. We should see rates go down, but not so fast. There's a competing factor, which is inflation. And as we move forward, and now there's a definitive end date with vaccines coming.
Vaccines, yeah.
There is going to be a push. There's going to be more demand. There's likely to be a kind of a dearth of supply. And so this could push prices higher. We could see a spike in inflation, and that inflation is like kryptonite to low rates, pushes them higher right away. So we've got competing factors. We also have the factor of mortgage lenders are not organically pricing their interest rates anymore, because mortgage lenders are so swamped with new mortgages, with everybody in the whole country can refinance with the crazy low rates, that they're artificially pushing their rates higher and not pricing them to mortgage bond prices. So, I mean, you take all of that and also add to that the fact that the Fed is buying mortgage bonds, creating artificial demand in the mortgage bond market. If the Fed winds down their purchases, we could see rates spike from there as well. So, I mean, I don't like to overplay the inflation issue. I think that could be tampered down. So I think we're going to see rates in the 3% range for the next year. I think we're going to be par. I don't see the Fed winding down their purchases, and I don't see inflation spiking to the point where rates would start spiking on us. But I also don't think, and there was some talk, a few months ago that rates would go below 2%, especially in the new year.
Yeah.
But I think that with the vaccine coming, I think that that's not going to happen.
So you're basically saying you think that things are going to be largely the same, or maybe a slight increase, but we're still going to be in the threes,
I would
somewhere in
agree with
that
that
range.
characterization.
Okay.
Yes.
Well, I want to thank you, Paul, for joining us this week. I think you've given a lot of great information for people that are out there watching this. Again, everybody, we will put up Paul's contact information. If you are looking to buy, well, you can talk to both of us. If you are looking to refinance, probably just him. But if you have questions, I can probably steer you in the right direction to Paul as well. Again, we do a market update video. We do one for first-time homebuyers and one for our general market every week. So definitely check those out. Do not forget to like, subscribe, and hit that notification bell if you're watching us on YouTube. And once again, thank you, Paul, for joining us this week. And I'll be talking to you a little bit later about a couple of files we have in process. And everybody out there,
thank you for having me, Stephen.
and everybody out there, we will see you soon. Thank you so much.